how are you? Thanks for having
Uh,
me back on.
yeah, no, fantastic. Great. So I don't have to drag you back through your childhood and life again. So we're going to pick up because I think our audience will be particularly interested in somebody who's been involved in finance and particularly what's happened over the last year and a quarter in COVID. So if I can take us back to where I suppose really the beginning of 2020, um, what happened when COVID? What was the landscape like and how did it suddenly change with the dynamic of COVID coming about?
Well, like the lenders, like anybody else, were in absolute shock and froze up for a while. Everybody just sat on the fence and stopped lending at that point in time, and we're waiting to see what happens.
Also, okay, that's the lender side of it. But from a client's point of view, I mean, clients are varied. Were some responsive? Did some just kind of go into their shell? What sort of reaction were you getting from clients?
Well, first of all, I was proactively contacting any clients that I dealt with in the past because the lenders were offering forbearance at the time. So I was making any of my past clients aware of that. But also lenders were open for business for any business that was continuing to trade. They were certainly able to offer finance. Some of their funding lines of credit were withdrawn. So at that time, some of the interest rates could have been a little bit higher, but they certainly were willing to support where they could.
Yeah, it's amazing. I think a lot of people fail to understand that banks themselves need to access finance to facilitate their own clients. So what you're saying is some of those lines were chopped for them as well.
That's right. So some of the lenders that I deal with are alternative lenders. They might have their own peer-to-peer crowd lenders who are ordinary people who chip in on business loans, but sometimes they have institutional lenders and some of those pull the plug at that point in time, but there was support wherever it could be made.
Right. We're going to talk about the varying types of lenders in a few minutes. I just kind of want to move back there in terms of, I know when we were chatting, you were saying some of your clients were actually quite responsive in terms of understanding the potential situation coming up. How did they handle the situation?
Well, at the time, the government was pushing to be prepared for COVID and making an action plan, and the local enterprise office was offering support where they could. So people were coming to me with those plans that they had made, and they said, we may be undercapitalized, we need a cushion of working capital. And I was able to offer them loan quotes where they could have that working capital without an early repayment penalty on the loan. So, if COVID died down, they could basically hand back the bulk of that cash and walk away penalty free from whatever the remaining interest would have been. So there was flexibility at that time, but it wasn't perfect. The government hadn't caught on to it yet with extra supports and loans that they were offering as well.
Yeah, it's quite interesting. It's amazing. We see different types of business entrepreneurs out there. And in this case, these were the ones who recognized a pinch coming down the line and were reacting before it became a real problem.
Exactly. So even some of the business owners just wanted to know that they potentially had access. They didn't need it right now, but they were able to get that feedback from the lenders saying, look, we've had a quick look at your accounts and your bank statements, and we would be happy to support you if you want to take it to full quote stage. So they were always happy to give feedback wherever they could as well.
And typically, what sort of methodology were they using? Were they using sort of overdrafts, or was there some like term loans? What was the most popular way of dealing with that?
Well, essentially, a lot of the business owners that I deal with, they've already been to their bank. And at the time, the banks were withdrawing their overdrafts. They were getting scary letters, and they were then feeling they weren't getting that personalized service from their banks. So they were looking at what else was on the market and dealing with alternative lenders who at that time were giving more of a personal touch almost than their own banks.
Right. I think it'd be fair to say that the government actually were quite quick and quite responsive in terms of recognizing that there was a shortage of funds out there. So talk about what they put in place and how you think that addressed the market needs.
Well, that's it. They funneled money into the SBCI, the Strategic Banking Corporation of Ireland, and they allocated funds then out to pillar banks mostly at that time. So what they found, the main one was the COVID-19 credit guarantee scheme, where 2 billion euros was allocated, and it was being funneled out through the pillar banks. So the feedback I was getting from my clients were that the process was a little bit tedious, difficult to deal with, and the take-up was actually quite low. So by the time it came around to Christmas, only 5% of the 2 billion allocated had been drawn down. So it seemed there was a lot more movement after Christmas where non-bank lenders were getting access to funds who had lower paperwork requirements, and they were more willing to be able to lend in certain situations, where whether that's on invoices or refinancing business assets or simple unsecured lending.
So really what we're talking about here, that I suppose what we're talking about is the pillar banks were a lot more cautious in their approach, fairly much, underlining where they've been. They hadn't sort of shifted in terms of their appetite for lending.
Yeah, well, the pillar banks, they are stuck with old systems and old processes, and they're not essentially that agile, whereas new business lenders on the market have better systems and better processes essentially in place. So a lot of the non-bank lenders are just plain easier to deal with. But not that being said, the pillar banks were funneling a lot of cash out at that time wherever they could, but it was just a bit too slow for some business owners.
Right. I suppose this leads me on then just to talking about, and I'm sure our listeners would be particularly interested in, let's work our way through some of the alternatives, because a lot of businesses are not aware of things that are out there. Maybe you might take us on a walkthrough of some of what's available and the sort of client that would be most appropriate for it.
Okay, well, starting out at the start, some of the cheapest money around at the moment is with Microfinance Ireland. So generally, the local enterprise office is teamed up with Microfinance Ireland. They can do a max loan maybe of 25,000 euros, and they're offering like an interest-free period of 6 months and a low rate of 4.5%. So that would be an easy one for a micro business owner out there, where they essentially could get a cushion of working capital, and even if 6 months pass, they could hand that money back and settle the loan early. It's just to have a cushion of working capital, and with the flexibility to pay it off early. Now, a lot of business owners I deal with are looking for 100,000 euros or 200,000 euros or whatever it might be. So some of the alternative lenders I deal with have access to the lower rates of the COVID-19 credit guarantee scheme. So essentially, the government's taking on 80% of the risk of these loans, and that means the lender has access to cheaper rates. Also, for peace of mind, there is no personal guarantees involved. So you hear all these scare stories with the banks, people are getting chased forever with the personal guarantee, but with this money, there's peace of mind. If the business ultimately ended up failing or something went wrong, you're not going to be chased forever on that. So,
okay. Can I just ask you a question? If I go back to the microfinance one for, as I said, the micro businesses and for 25,000, sort of what term are they offering that over? And in terms of repayments and the paperwork that might be involved, was it sort of arduous or was it easy to access?
Well, it's relatively easy. There are easier options out there than microfinance, but essentially any business that's been trading maybe at least about a year would be a reasonable one to go for this. They have a simple application form, which essentially is the bones of a business plan. There's a bunch of questions to answer, but it wouldn't take more than a couple of hours of your time to fill that in. And they're looking for the usual things: accounts, bank statements, and a few bits and bobs like that. They may follow up with more requests if they have clarifications that they want as well.
I think this kind of then highlights what a lot of small businesses fail to have, is actually a business plan in place with proper cash flows and bank reconciliations and things, which I think, if I was to give a tip now, is to say you should always have that, because if you need finance, they're the things they're going to come looking for.
That's agreed. And I find that there are templates out there for business plans, but it is a scary process to go through, and not every business owner has the capability of doing a business plan. So I actually have some contacts out there who are professional business plan writers and financial modeling, and I often help business owners with that for going through bank loans and things like that as well.
Okay. Moving on to the sort of the credit guarantee side of it, typically what sort of size business was involved in that? And were businesses in the hospitality sector in particular, were they excluded or were they looked after? Tell me a bit more about that.
Well, a lot of the businesses, like what they started calling wet pubs, or people who had to close completely, they were literally having to rely on whatever government supports were out there. Lenders still had to make a business decision on whether the business is viable and will they come through this. So unfortunately, there's been a lot of businesses that have shut completely, that weren't supported. However, the government did step in wherever it can with supports and wage supports and all that kind of thing. But what the non-bank lenders and alternative lenders did is any business that continued to trade even on a reduced capacity, like restaurants that were open for takeaway or whatever, they would support them to a certain extent with a view to topping them up as lockdowns eased. And I did see a lot of support for businesses and helped a lot of takeaway type businesses as well during that time, or anyone continuing to trade.
What was the typical sort of size of package that businesses were accessing through the guaranteed scheme?
Well, the prime for unsecured, it was anything from about 10K up to 250K unsecured.
Wow,
so then if it was going up towards $1 million, a portion of it needed to be secured finance under the COVID-19 credit guarantee scheme. So they couldn't hand out really significant amounts without some sort of security.
So I suppose, their look at the business was quite robust in terms of making sure that all the information was available to them. And typically, how long was it taking for decisions to be made?
Well, with the alternative lenders, I was seeing turnarounds of days, really. So they would look at some simple documents like accounts, bank statements, tax clearance certificate, and could make quick decisions. So the lender, some of the businesses didn't have their latest set of accounts done, so they might have to put a bit of effort into getting some management accounts. But sure, that was the main hassle.
All right. Okay, they were able to do that. All right. I suppose what else is out there? Talk to me about what else is out there. Maybe unsecured if necessary. If it's not, let's just take a walk down the laneway of finance. What's out there that people should be considering?
Well, sure. I mean, not every business can get as much as they want to get on a simple unsecured loan. So if the accounts are weaker, there's maybe some missed payments stacking up. Any business that has assets can potentially get refinance of machines and vehicles and things like that to release some working capital. And that's under the COVID-19 credit guarantee scheme. Some lenders have that as well. So the rates are relatively low and can get some working capital. If any business needs new assets right now, so if they could trade better through COVID or they're pivoting their business, they can get leasing and hire purchase under the COVID-19 credit guarantee scheme, which basically means they can get terms up to 5 years and even up to $1 million is possible for that type of lending.
In terms of accessing your existing assets, how were people calculating the sort of value of those? I mean, obviously the lenders were, but were they giving fair valuation on them?
Well, yeah, the lenders essentially were in a pickle in that they couldn't go out on site to inspect the assets all the time. So they did have their own difficulties at the time. But essentially, they're going to request the make, the model, year of manufacture, how many hours are on the machine, and they'll ask you for a guesstimate of what the values are. Now, they have their own assessors within the business who then will assess, but generally they will do it on a fair enough basis. But they do also need to factor in things like depreciation over time and how much they will release. So there's a lot of calculations that have to be done. But in any event, they're always happy to give indicative rates and pricing, and there's no obligation or cost to build these quotes generally.
I mean, that's quite interesting because a lot of companies out there would have machinery that's quite valuable, but possibly have no cash. So really what we're doing is leveraging the asset to raise the cash.
That's it, exactly. And the same goes for business-owned property as well. Some businesses had equity inherent within buildings, and if they needed a significant cash injection, that was possible as well. Other businesses were owed a lot of money. Now, invoice finance, alternative lenders did get access to some of the government money as well. So what they were able to do was assess the book of debtors. They might not release all the funds if some of the debtors were classed as high risk, but the situation is very fluid. So they might say, look, we're able to cover half of your book of debtors and release maybe 80 or 90% of the cash today, and then the rest when your debtor pays. And as time goes on, they can always reassess that situation.
It's amazing when we talked about discounting and invoice discounting and factoring is, if I remember correctly, is what it used to be called. That's moved on in leaps and bounds, and there's many people with different offerings in that. Would you like to take our audience just through a couple of the different types that are out there? Some are obviously more expensive than others, but maybe give us a...
Yeah, Alec. Well, first of all, for a lot of business owners in Ireland, invoice finance wasn't their favorite choice of finance. In the past, it was associated with people calling up your debtors and wrecking your relationship with your clients. But these days, there's a much more standoffish approach where they will just look at the book of debtors and make a judgment call on who the best ones are. They will tell you, we're happy to finance this one. And it can be on an ad hoc or one-off basis. So the old type of invoice finance, they might charge you a regular monthly fee, whether you're using it or not, just to have access to the facility. And the fees could stack up quite quickly. Whereas because of the efficiencies of fintech lenders, they're able to just pick out certain invoices. It could be a one-off situation, it could be in a regular situation, and you can just choose when you want to cash in some invoices early. So there's a great service out there from a number of lenders, and it certainly has moved on in recent times.
Just remind our audience where they can find out more about you, Rupert.
Well, first of all, the main thing is you can find me on Google. If you just type in businessloans.ie, you'll find me there. And I'm available to answer your call 7 days a week. So my number is 015563655, and I'm always happy to have a chat with any business owner.
Okay, thanks for that. I mean, we were talking about that. I think that's quite interesting in terms of being selective with your invoices. So you might have a pinch somewhere and just decide, okay, I'll put that one off through. And if it's hopefully a good sort of debt for the lender to look at, they could finance you up to about 80% of it.
Yeah, generally for the one-off type ones, it's up to 80%. Now, the lenders can push it up towards the 90% mark. And then once your debtor finally pays, there's a final settlement, and they might take their 1% or 1.5% or whatever it might be per 30-day period of time. So that can be quite flexible, and it can actually work in tandem with trade finance. So if you're a business owner and you are importing shipping containers from China, and with logistics during coronavirus going crazy, your working capital could be tied up for weeks or months. Now, you could use somebody else's money with trade finance. So they will essentially finance your purchase order in that situation if you're dealing with quality businesses.
So this is kind of the reverse of invoice discounting. It's they're sort of nearly buying your purchases invoice.
That's it, exactly. And even that's focused on traditional goods, like it could be shipping containers, it could be reacting to Brexit and finding new markets. But essentially, you can get a line of credit approved for your company that you only pay for when you use, and you could take advantage of opportunities that you otherwise couldn't have by using a lender's money, and the interest rates are fairly reasonable for that as well.
And in what sort of terms are these companies offering?
Well, most of the time for trade finance, there's a number of different lenders on the market. Now, I've been speaking with guys who are importing or exporting cattle, and they're dealing with countries like Libya, and they're high risk, so they might have to pay something like 3% per 30 days. Whereas if you're classed as a lower risk, you'd expect it to be maybe 1% per 30 days of time.
Right. As you said, it's sort of the fintech world. There's been a seismic change over the last couple of years in those coming onto the marketplace. Let's talk about some of the more creative people who are out there who are offering things, maybe either sectorial or something.
Oh, well, there's a company that's operating out of Ireland offering finance for e-commerce businesses, and they're called Wayflyer, and they are tipped to be Ireland's next unicorn, so $1 billion business. So essentially, the company started out with a guy named Aidan Corbett, and he had analytics software that would look at your ads and your ad spend. And then he realized he could marry this with finance and basically offer you money towards your ad spend and your stock. So a company in Ireland called Amber Eyewear started using them. They were selling these glasses that take away the blue light from your laptop screen and protect your eyes. And literally they turned from a small startup to a €1 million sales business by using this continual finance. So that's my favorite business at the moment, and I think they're doing great.
Right. Tell me just a bit more about that, and who would be accessing you. You've given an example of some of your class, but who else would be sort of a good candidate that we might know? I don't mean name a company, but just a sector.
Oh, sure, yeah. Essentially, any business that's operating in an e-commerce sector. So they could be selling jewelry, they could be selling kids' toys, anything like that. So the kind of people who are setting up on Shopify or some sort of e-business or Amazon or whatever it might be. Most of these businesses, they need to spend a significant amount on ads to get those clicks and get that spend. And also then they need to get a decent price on their stock, and to do that they need to put in a significant order. So this type of finance plugs in, and it uses all that beautiful data and is able to make you an automated offer month by month and grows with you.
All right, so this is kind of using this sort of what do they call it, big data, and analyzing it in a way that just crunches the numbers very quickly.
That's it. And it's the term at the moment is embedded finance. So essentially it's plugged into your site. It's offered to you on the menu, a bit like at your checkout. So you'll see a lot of people talking about Flexify, and there's people getting home offices or those sorts of things out in their back garden. And a lot of these are kind of married with some sort of easy payment plan, and it's plugged in with some finance in the background.
Wow. And in terms of sort of applications, are they quite onerous, or are they much more easy because they're able to gather the data themselves?
Well, yeah, essentially the applications are quite easy for this type of thing. They'll take a few simple documents from you, bank statements, and if it's the e-commerce sort of one, they will need to plug into your analytics so they can make a judgment call on the finance decision as well.
Okay, fantastic. Let's move on to something else. Crowdfunding, for example, it's not new, but has it become more adaptive and resilient in the world?
Oh yeah, so there's two key types of crowdfunding on the market at the moment. There's debt crowdfunding for loans, and that's been around. I personally used to work for the likes of Linked Finance and Flender early in my career, and essentially any person can chip in on a business loan and get a better interest rate back than they would if they leave it in the bank at the moment. Now, on the other side of things, there's equity crowdfunding. So equity crowdfunding, you're giving up a piece of your business in return for equity, but there's no repayment. They're basically going to get paid back on their share returns. So that's more suited to these techie companies that need a lot of investment early on. And a key example would be a company in Ireland called Spark Crowdfunding. So they are doing that equity crowdfunding, and there's companies out there like Moby Bikes, who have those bikes that you'll see around the city, and all sorts of interesting, innovative businesses that can get access to capital where otherwise they would never have been able to get it.
And so I presume, some of these businesses might have huge appetites for funding, and these people are prepared to get involved.
That's it. There's people during COVID-19 have had a lot of downtime, and also investors who want to chip in on businesses. They have more time to do their research and feel if your business is a good bet to invest their funds into. Also, the government has the EIIS scheme, which essentially makes an incentive for investors to chip in on equity-based financing, and there's a 40% tax rebate for these businesses. So a lot of the businesses that use equity crowdfunding are kind of paired up with these tax incentives that make it sweeter for the investors as well.
Just for a second, I'd just like to look at it. I suppose if I had a whole bundle of money sitting in the background, I could become one of these people. They would be interested in my money and help me spread it out and spreading the risk.
Exactly. So there's a lot of opportunity out there. And with anything, you don't put all your eggs in one basket. So if you're investing in a business loan or an equity, you just have a portfolio like anyone else. So you could invest in ecologically friendly businesses, or you might be interested in certain industries, and you can become an expert in your own niche and be an investor yourself. And at the moment, it's negative interest rates with the banks. So people are looking for these opportunities, and they are out there.
Okay. Obviously, there's an element of risk as with all sorts of investments, but are there any stats on that at the moment?
Well, any of these lenders will have a default rate, and if you're doing your research on the businesses for debt funding, you can see that there. And likewise, if you're investing in startups, you know, the reward can be good, but the risk is there as well. So, like anything, you speak with your financial advisor, and you have a portfolio spread. Like personally, I don't offer any financial advice, so I'm not promoting investing in loans or anything today. But you know, each to their own. If you're looking for alternative investments, they're certainly out there.
Anything else of interest and excitement out there that business should be aware of?
Well, yeah, I think basically the key thing at the moment is it's better to be overcapitalized than undercapitalized. So essentially, most of these loans, they don't have any early repayment penalties. You can have working capital in the bank. It can give a business owner a different mindset by just literally having access to those funds to pursue an opportunity. So I would say, don't just think of your bank manager or your pillar bank when you're thinking about finance. There are a lot of other options out there and niche opportunities that can help your business grow or support you in certain ways. Businessloans.ie is always happy to have a chat with any business owner and organize any quotes and get indicative pricing or whatever a business owner needs.
Yeah, I suppose it comes back to the old adage, because I was in banking a long time ago, and I always remember never ask a banker for an umbrella on a rainy day sort of thing. I suppose this is the same advice still there. You know, ask for money when you don't need it.
That's exactly it, Alec. So the sad story is there's 1 in 4 businesses now is classed as a zombie business, apparently. And what that basically means is they're relying on government supports, but when those supports dry up, they're not going to be viable businesses. So there's going to be 2 things going to be happening. There's going to be a big increase in mergers and acquisitions this year. And there's any business that has their eye on a good deal where they could buy another business, they can get financed and acquisition finance. So they can raise money off their own business, and then when they take over another business, there's more finance to be raised there if they need to. But on the other side of things, the government's taking care of a lot of businesses at the moment with initiatives like SCARP, which is the Small Company Administrative Rescue Process. So basically, in the past, if you're in trouble and you need to restructure your debts, it can be very expensive going through examinership, and it often ends up in the courts. So what they're trying to do is make it viable for micro enterprises to engage with an insolvency practitioner if they need to. So that's something that's coming online, and there's other things like that to help businesses survive and support jobs.